What's going on, everybody? Welcome back to episode 18 of Bound to Improve. My name is Landon Eller.
And I'm Chris Pound, and the book that we read this week was The Big Short by Michael Lewis. I'm sure most of you guys are aware of what happened in 2008 with the housing market crash, and this book kind of dives into what was going on the inside of the financial industry.
Yeah, so moving into the implementation from last week's book where we read Poor Charlie's Almanac, which was just a bunch of speeches. Yep,
from Charlie Munger.
Yep. So my implementation, he had a bunch of psychological tendencies that he said that he used throughout his life as part of his mental models. So I tried to tie events to these psychological tendencies. So one thing I found was the inconsistency avoidance tendency, which is just human nature to not want change. So I was at an event this previous week, and you know how growing up in high school, or even before that, it's always girls, boys.
Mm-hmm.
So we were at an event, and it's a bunch of early to mid 20-year-olds, and it was the same thing.
Okay.
So I just thought that was interesting in terms of that changes, like people still stay away from that change, and they're still doing the same thing.
Yeah. Is that all you have for that?
Yeah, it was tough, and I definitely could have done a better job at grabbing some more events, but I'll just leave it at that.
Mine was to be more reliable, and Landon hit me with the question, how am I going to truly be able to implement that? And after doing some thinking, I kind of came up with the idea that I kind of have to kind of just ask if anyone needs anything, right? Go out of my way to be reliable. And I guess the most specific thing coming to mind is I had a friend who was sick over the weekend, and I was headed to the store, and I asked, I'm here, do you need anything? And they said some cold medicine would be really helpful right now. So I just went out of my way, bought the cold medicine, took it to him, and that was the end of it. It wasn't one of those things that I was looking for anything out of that transaction. I was just going out of my way to do something to become more reliable, to just for that person to know that I'm always there, regardless of what's really going on.
Yeah, that's good in terms of you're not waiting on it to happen, you're being more proactive.
Actionable, I would say, yeah.
Okay. No, nice.
Yeah.
So moving on to the summary of the book. So how this book was kind of structured, it was basically a story of exactly what unfolded, and it gives three particular individuals who were a part of this. And then inside of that, it tries to teach you about what was the technicalities that were going on inside.
Before we started this episode, Landon read me a quote from Michael Lewis, and I'm not sure if you wanted to talk about that yet, or do you want to wait till the end to talk about that quote?
I'll just wait till the end.
Okay. But yeah, so I guess the first thing we have to share is what really went on at Wall Street during 2005, 6, 7, 8, and thereafter. And I kind of let Landon take the lead and then add in my points along the way.
So the main crux of the market crash was from the housing market.
Yeah.
So what was happening was the banks were issuing mortgages, and then the mortgages were being repackaged by your investment banks, think Goldman Sachs, Bank of America, and selling those group of mortgages to investors in a bond.
Hedge funds primarily is who they were selling the group of these mortgage-backed bonds to. But the thing that kind of caused this whole thing was who were they were giving the mortgages to. And they were people who had, say, an income of $25,000, $30,000 a year with no collateral, nothing to kind of leverage their bet against. And they were given loans for $500,000, $750,000, $1 million house that ultimately the banks knew they were going to default on them.
So initially, that the people they were giving the mortgages to were credit worthy.
Yes.
Then they started, and those mortgages were government backed. That's what made those bonds that the investment banks were repackaging safe. But then, to Chris's point, they started to issue mortgages to people who were not creditworthy, bad credit scores, lack of income, no other assets, and these were not government backed, and these were noted as subprime mortgages.
Yeah, and I'd like to say there's one big thing that kind of influenced all this to happen, and that would be greed. The people on Wall Street, they were getting paid commission, and they're 2% off the top, and that ultimately, when you're doing things like this, you kind of have an ethical question in mind. Is this good for only me, or is this good for everybody? And at the time, it may look like it was good for everybody, but the people on Wall Street knew that this is only good for me. I'm not worried about the future.
Yeah.
So don't let greed get in the way of doing the right thing.
I think that's like what the main theme of the story was.
Yeah.
So once they sold the normal bank that you would go around the corner to, once they sold your subprime mortgages, then the investment banks were still buying groups of those subprime mortgages and grouping them together into a bond.
Yeah.
And these bonds had different layers, which were called tranches. You can think of these as different groups.
Mm-hmm.
The groups then were spread out based on how safe they were, or how risky they were in terms of, were they paying a high interest rate, low interest rate, did they receive the payments first?
Did they have credit history in the past? Just simple things that nowadays are way more important than they were during this time frame, for the reason of the housing bubble to pop.
Yeah, so this is where investors like Michael Burry, who is one of the main figures in the story, started noticing that what is included in these subprime mortgage bonds, on the lower half of the tranches that were made up of really bad mortgages, they were very highly likely to default.
Yeah, he in the book it talked about how you had this 100-page booklet of what was in these bonds, and the only people that actually ever read the booklets were the lawyers who put them together. No one else ever did, other than Michael Burry. And once you got down into the fine print, you realized there's no floor, right? It's a glass floor, and if you have too much pressure, it's gonna collapse and fall from underneath. That's exactly what it did.
Yeah, so he was one of the first to ever pick up on this.
Yeah.
So what he did was, there's something called a credit default swap.
Before we get into that, there was no way to short these mortgages, these bonds, and so that's when he came up with the idea of using
A credit default swap, or a CDS, which is basically insurance against the default of the bonds or the loans. So if he bought a CDS on, say, subprime mortgage bond A, then if that default, then Michael Burry got paid.
Yeah.
If it didn't, he would have to pay a certain premium every year to keep that credit default swap. So these were not invented on mortgages yet.
Mm-mm.
So he had to go through a whole bunch of hurdles to try to get these credit default swaps created.
And it was a zero-sum game. If one party profited from the default, the counterparty lost. And so the thing that kind of separated Michael Burry from everyone else that was doing this was the time frame that he did. As soon as he realized what was really going on, he went all for it. And people were looking at him like he was crazy, because the amount of leverage that he was using in order to acquire these CDSs.
Yeah, and at the time, like, the housing market was still going strong.
Yeah, it didn't look like the bubble was ever going to burst.
No. So on top of what he was doing with the credit default swaps on the subprime mortgage bonds, the investment banks then went to create another security. So what they did was they took the subprime mortgage bonds, which had a whole bunch of different tranches or groups of different riskiness layers of bonds. They took the most risky parts of the subprime mortgage bonds.
Triple B negative or positive?
That and lower, I'm pretty sure. So they took those types of bonds they took those types of mortgages from the bonds of a bunch of different ones.
Yeah.
Then they repackaged those together, and then they resold it off.
They got it regraded by Moody's and the S&P, which, going from a triple B to a triple A is huge. And but the thing about it was these newly rated triple A's were just full of triple B's, so they had no substance and they had no reason for the value to kind of increase.
Yeah, and this went on for an extended period of time because, like Chris said earlier, nobody knew what the heck made up of any of the subprime mortgage bonds or the collateralized debt obligations. Everybody was just buying them because they were collecting fees from having it pass through their investment bank or the insurance company.
Yeah, exactly.
So eventually, there's a couple different things that happened. Most of the mortgages were on the subprime mortgages had a fixed rate for 2 years, and then it went to a high floating rate for the remaining period. So after that 2-year period was up, you were likely to see higher defaults.
Yeah, they were promised like a 6% interest rate for 2 years, and then after 2 years, it turned out to be like 12%. And it was almost like it looked like it was only a 15-year mortgage, but it turned out to be a 30-year mortgage with a rate of 12%, which is astronomical.
Yeah. So that, and then also housing prices stopped rising.
Yeah.
That together made all of these subprime mortgage bonds and CDOs start to lose dramatic amounts of value because they were all defaulting on their loans.
Yeah.
And who held all of these things? There was major investment banks, major insurers like AIG,
Lehman Brothers,
Bear Stearns, etc. So the people who bought those credit default swaps on the subprime mortgage bonds and the credit default swaps on the collateralized debt obligations are who was really profiting in this instance when those defaults started occurring.
Yep.
So ultimately, this led to a whole bunch of regulatory oversight because the high financial world ultimately created securities that nobody knew what the heck was going on with them. But a couple key people like Michael Burry or Steve Eisman were a couple of the figures who noticed the goofy accounting and these subprime lending firms that would ultimately cause the collapse of many of them.
Yeah, when the housing bubble did burst, that's kind of when the Fed got involved. And one of the points I have here is that once it did burst, the Fed bailed out AIG with an $85 billion bailout. Why did they choose AIG rather than, say, the Lehman Brothers to bail out, in your opinion? Or do you what are your thoughts on that? How do you pick and choose? It's kind of like last year when the Silicon Valley Bank started to default, and the FDIC insures people up to $250,000. Well, in Silicon Valley, $250,000 is essentially pennies to those people, and so they were being insured for more than $250,000. The question is, where do you draw the line from that standpoint?
It's a head scratcher. Those are some things that I don't think I'll ever understand.
It's like the rules don't apply to specific people.
Yeah.
Which we might be getting a little too deep into.
Yeah. It's just the banking industry was ultimately taking advantage of the people on the poor economical end of the spectrum by offering them loans that they knew they couldn't afford because they were collecting fees off of that.
Yeah.
which they eventually sold off to their investment banks, who repackaged them and sold them again. And those investment banks were collecting fees off of selling those. So it was just like a cycle that kept going. And as housing prices kept rising, then that just kept growing and growing and growing.
Until the floor dropped from underneath them.
Yeah.
And you had the big burst of the bubble.
Yeah. So, you want to do a quick recap of kind of that process in chronological order again?
Yeah, we can.
So at the beginning of the early 2000s, mortgages were being sold. Then the banks would sell those off to investment banks, who would group those individual mortgages into a mortgage bond, and sell those off to institutional investors.
Yeah, and then in 2005 and 6, that's when Moody's and the S&P were almost like influenced to re-rate these new bonds from previously being a triple B to now a newly triple A, and that just added to the inverse effect of what happened.
Yeah, and just to solidify on your point, they were the mortgages eventually became subprime mortgage bonds.
Yeah.
Then they took the lower layers, which were the most risky layers, or your triple B or lower ratings, and repackaged those into another security to make it look like it was triple A.
Yeah, if you've got a dozen apples that are all brown, and you take one of those apples out and replace it with another brown apple, it's still a dozen bad brown apples. But they were re-rated. So it's almost like you've got a group of bad apples. You take a few out, you add a few in, and normally it'd stay the same. It's still a bad group of apples, but they were re-rated into these AAA bonds, the subprime mortgage bonds. It's a concept that's hard to fully grasp, because the stuff that was going on during this time were very shady, and I don't know if we'll ever truly understand what was going on, because when people take billion-dollar losses, they don't want to talk about those type of things.
Yeah, and most people didn't, and it's a great book in terms of, it's just a head scratcher. Like,
yeah,
you could point at the lower end banks making the initial mortgages. You could point at the investment banks for creating new securities. You could point at the rating industries for reclassifying those securities as better than what they actually were. You could point at your finger at the insurers who said they didn't know what was going on, so they kept insuring those things.
It's like reading this book. Multiple times I stopped and thought to myself, how is any of this like allowed? And it's because there was no regulation on any of it, and again, that added to the bubble bursting. And
it almost makes you think of what's going on right now.
Exactly,
that we have no idea.
Exactly, that's a good way to put it.
Well, I think that's we wanted to try to provide the highest level overview that we could, without confusing ourselves.
It's a very confusing point of discussion when it comes to the mortgage-backed bonds and the subprime mortgages, but we kind of did our best here. Along with that, we really don't have any implementation from this week, just solely due to the fact that
just thought it was tough to pinpoint something that we could try to.
I guess my implementation is don't apply for a mortgage unless I've got income or something. I don't know how you can feasibly apply anything from the book. Not saying it's not a bad book by any means, but just from our specific scenario.
I would say it's a good book for history and understand what went on, but in terms of creating tangible steps that you can take to implement in your life going forward, it's tough, because it's more of a preventative book to make sure you don't see that ever happen again.
Yeah.
So kind of moving on to our favorite quotes here. Mine was from one of the initial ones here. The most difficult subjects can be explained to the most slow-witted man if he has not formed any idea of them already. But the simplest thing cannot be made clear to the most intelligent man if he is firmly persuaded that he knows already, without a shadow of doubt, what is laid before him. And this was by Leo Tolstoy. And what this was saying here was most of the people who were dealing with these securities, they didn't even know what was going on like within them.
No.
But if you, like, it mentions how if he already thinks he knows what it is, he can't be persuaded otherwise. And that's how many of these people were, and they just kind of turned a blind eye, which ultimately led to that big collapse.
Moving on here to my quote, the people who have the gold make the rules. I just think that's a
fitting for this.
Exactly. And along with that, I have one more quote from Warren Buffett. To succeed in a spectacular fashion, you have to be spectacularly unusual, right? You kind of always have to. You almost, to an extent, have to be crazy for doing the thing that no one else wants to do. No one else is willing to put the time and effort into these type of things, and that's what makes you unusual to an extent.
A good crazy.
Good crazy. Is there a bad crazy? What's normal? Exactly.
Who knows? But that leads us right into our next week book, and this is As Many Reps as Possible, as by Jason Khalipa. And this is a story of someone who faced a lot of turmoil,
a lot of adversity
in his life, and he just has a very good philosophy on how to live your life on a daily basis. So we're excited to dig into that one.
Yeah, he's got a mindset of a champion, and I'm excited to share the experiences that we've been able to pull out from the book.
Awesome. Thank you guys for tuning in, and make sure you follow us on our socials.
Yep, Bound to Improve on Instagram and TikTok, YouTube, Spotify, and Apple Playlist podcast.
Awesome. Thank you guys, and we'll see you next week.